Hi everybody, let's in this video cover a very important type of financial asset, that is a bond. We'll answer these questions first. What is a bond? A bond is just an IOU. It's a piece of paper that guarantees the holder of the bond two things. Regular interest payments every year is number one, but also getting the value of that bond back when it matures, the face value of the bond back when it matures, i.e. when it's owed back to whoever has it. Who issues the bond and why? Well, there are two major economic agents that will issue bonds. You've got governments who need to raise finance in order to finance their spending in the economy, on infrastructure, on education, on health and welfare. So governments that don't have the tax revenues to fund their spending will need to borrow. Issuing bonds is one way they can do that. Corporations as well, firms who are looking to invest, if they don't have the retained profits to invest, then how else can they gain that finance? They'll need to borrow money, and issuing corporate bonds is one way in which they can do that. So the reason why is simply to raise finance when governments and firms don't actually have that finance available to them right now. They can issue bonds and borrow. Then that begs the question, who on earth will want to buy a bond and why? Well, anybody can buy a bond. An individual can buy a bond, no matter where they're located in the world. They can buy a UK government bond, for example. Firms can buy bonds. Governments can buy bonds from each other. Anybody can buy bonds. And the reason why really is twofold. The yield on the bond, the return on the bond, might be better than the return on other financial assets out there in the economy. So that's a very important factor as an investment for somebody. But also because it's safe. Take a government bond, for example. Governments are very unlikely to go bankrupt. Yes, there are one or two examples that we can think of, but it's rare for the UK government, for example, to go completely bust and therefore not pay back whatever bonds that they've issued, right? Very rare. And think about most other financial assets. To give you that kind of security is unheard of. So that's again why some people might want to buy government bonds, for example, as a safe haven for their money, guaranteeing a certain rate of return, which might be a very lucrative rate of return. Let's go straight to what a bond looks like. What I've drawn here is a UK government bond, and there are four things that will be on this piece of paper, on this IOU. You've got the name, and in the UK the individual name of a government bond is a treasury, but the collective name for government bonds in the UK, gilts. You've got the coupon. The coupon rate is the interest rate that is paid based on the nominal value of the bond annually, but this coupon rate is fixed over the duration of the bond. That coupon rate will not change. So we've put here 5. So that is £5 every year that is going to be paid to whoever holds this bond. So it is actually a percentage rate, but it's a percentage of the nominal value. And if the nominal value is 100, then that's £5 worth of interest paid every year for the duration of the bond. That is fixed. You've got the maturity, and that will be a year. That's basically when the bond expires. That's when the government has to pay back this bond. Crucially, when the government pays back the bond, they pay back the nominal value of the bond. So upon maturity, the holder of the bond gets the nominal value back. I've said 2022, that's assuming that this bond is a 5-year government bond. I'm making this video in 2017. So 2022 is 5 years down the road. That means that this bond is a 5-year government bond. These government bonds can range in maturity. You can have 1-year government bonds, 3-year government bonds, 5-year government bonds, 10-year government bonds, 20, 30, 40-year government bonds, all kinds of different durations. And then you've got the market price of the bond. Remember, if we look at capital markets, you've got primary issue markets and you've got secondary markets. Bonds can be bought and sold, and if they're bought and sold, they'll be bought and sold in the secondary issue markets, at which point the market price of the bond is important. And the market price is simply determined by demand and supply for that bond. When you buy this bond fresh, you buy it at the nominal value, but then if you wanted to sell it, you would sell it in secondary capital markets, and you would sell it for whatever the market price is, and that is determined by demand and supply. Okay, this nominal value is really important, and it's important that we differentiate now between the nominal value and the market value. You might think, well, this is really confusing. Why is there one price here and another price there? Well, very, very simple understanding is this. When you go and buy a bag of carrots in the supermarket, you know you want to buy 1 kilogram of carrots. But if you go to Asda, you might be being charged a certain price. If you go to Tesco, you might be being charged a different price. But you know that what you're getting, regardless of the price that you're paying, is 1 kilogram bag of carrots. Well, that's exactly what the nominal value is telling us. The nominal value is just telling us what this bond is and what the end worth of this bond is. So if you hold this bond, you have got a piece of paper that is worth £100. That's the nominal value of it. Okay, what you buy it up for might be different, right? The market price might be different to that, but what you're getting is a bond that has a nominal value of £100. That's going to give you £100 back when that bond is matured. That's all the nominal value is there for, really. And that's why the market price can differ. What an investor will want to know if they hold a government bond is what is the yield? What is the rate of return they're getting? And there is a very important equation for the yield that you need to know. And here it is. So the yield on a government bond is equal to the coupon rate of the government bond divided by the market price. Divided by the market price of the bond. Now, of course, upon primary issue, the yield on this government bond is going to be 5, okay, because you pay the nominal value of it, absolutely fine. But we're assuming that somebody's buying this second hand now, and they're paying £115. They would need to go to the yield, the coupon divided by the market price, multiply that by 100, and that will give you a percentage rate of return. So let's do it for this government bond here. If somebody buys this bond up, they'll have to buy it at the market price, which is 115, right? So 115 with a coupon rate of 5. So let's put those two numbers into our equation. So 5 is the coupon rate, the market price is 115, times that by 100, and you'll get a percentage rate of return of 4.35% to 2 decimal places. So that basically is the interest rate on this bond. It is the rate of return on this bond. Bearing in mind what's been paid for it. 4.35%, an investor will look at that and think, whoa, given current interest rates out there in the UK economy, 0.25% is the base rate, bear that in mind. This is an incredible rate of return. I want to hold this government bond. That's how they'll make the decision of whether they want to buy this government bond, whether they want to hold this government bond or not. If that rate of return is better than other returns on financial assets in the economy, absolutely 100%. But the yield is what they would calculate, all right? And this is the equation to get the yield, and that's how they'll work out whether they want to hold government bonds or other financial assets in the economy. You need to be able to calculate this yield. This yield is actually a very simple calculation. A better calculation is the yield to maturity. I've made another video about government bonds in the fiscal policy context. In that video, I actually calculate the yield to maturity, which is a more realistic yield calculation to work out the real rate of return on a government bond. But for the sake of your exams right now, you don't need to know that calculation, you just need to know the very basic yield calculation. If you want more detail, go and watch that video to get it. Okay, having understood this yield calculation, what we can also work out is the relationship between the market price of a bond and the yield of a government bond. And the relationship is very, very simple. It's inverse. So when the price of a government bond goes up, the yield on that bond is going to go down. Let's understand why. If the price of a government bond goes up, the coupon rate is fixed, right, over the duration of the bond. So you're dividing a fixed number by an ever increasing number, and that's going to give you a smaller number. That's going to give you a smaller yield. Whereas, if the price of a government bond goes down, the yield is going to increase. You're dividing a fixed number by an ever decreasing number, and that's going to give you a higher number at the end, which is your yield. What's important to know now is actually what happens to prices of government bonds and yields of government bonds if the interest rate on them is higher or lower than market interest rates out there. Well, governments will look to set coupon rates to equalize yields or to equalize rates of return on other financial assets in the economy. So right now, if generally, let's say, that financial assets are paying a return of 1%, then governments will look for new issue bonds to set coupons of 1. Unless they're really desperate to borrow. If they're really desperate to borrow, they'll increase that, okay? But as a very simple example, they'll want to equalize the coupon rate with other market rates out there in the economy. But let's say that over time, the coupon rate is actually very lucrative and it gives yields which are significantly higher, like this one right now. 4.35% is so much higher than what you can get at the moment in the UK economy. So investors looking at that, or just ordinary individuals who are sitting on cash, will look at the yield on this bond and think, mate, I want this right now, this is incredible. That will increase the demand for these government bonds significantly. What will that do to the market price? It will increase it massively, right? And depress yields. And that will keep happening until the yield on these government bonds will reflect market interest rates out there. Simple demand supply will get yields to equalize. What if the yield was really, really low? Lower than other market rates out there? Well, demand for them would decrease, that will reduce the price of them, and yields will increase to equalize other market interest rates out there. So this is exactly what you need for government bonds. Lots of detail here for you. I don't see this kind of detail coming up in your exam, but knowing all of this, making you really, really confident with all of this, is the exact point of this video. Hopefully now you understand bonds in real detail, you can calculate yields, you can smash it when it comes to your exam. Thank you so much for watching, guys. I'll see you all in the next video.